Hey traders, welcome to Charts and Coffee. Happy Monday morning, everybody. We're taking a look at what is the post FOMC 50 basis point rate cut, post OPX morning, and we continue to see some follow through in some very familiar symbols. First off, I'm going to kick it off with gold. Gold continues to be very much a symbol, probably one of my favorite commodities right now, and looking at the long side of gold continues to be just a gift that keeps on giving. And that means that as gold moves higher, this should lend more clarity to gold miners and names like Barrick and Newmont Mining and things like that. So definitely keeping gold on the list. I get questions about silver every now and then. And the question is, Raghee, if gold's moving higher, does silver move with it? And this is where I'll say, when you look at metals are a lot like looking at the S&P, the NASDAQ, and the Dow. They tend to move similarly, but they're weighted so differently, they don't necessarily move in lockstep. So in this particular analogy, we know that the S&P is sort of like the NASDAQ and sort of like the Dow based on its weighting. Well, when it comes to silver, it does have applications similar to copper. Right? There's application to expansion, building, etc. And then gold, of course, is a play on real yields, real interest rates. So silver ends up sort of in the middle of copper on one hand and gold on the other, and it sort of looks like a mishmash of both, much like sometimes the S&P can look like a combination of the NASDAQ and the Dow. Now, if we want to get this right, the idea is to get that clarity in the other two, sort of the bookends, if you will. So to trade the S&P well, I need clarity in the NAS and Dow. To trade silver well, the more clarity there is in copper and in gold, the better. And then silver just kind of benefits from that. So I like copper. To the upside, copper is one of the two canaries in a coal mine, along with crude oil, that tend to rally if there's economic optimism. Crude's not getting the memo. There's certainly still a lot of heaviness in crude, which just isn't simply an economic optimism, obviously, conversation. I mean, in copper, in crude comes the question of supply. Is there supply to meet demand? Or is supply lagging behind demand? Or is there just way too much supply, even with the growing demand? So there's always those factors, but keep an eye on copper for sure. And we definitely want to continue to keep an eye on gold. All right, so that gets us over to the broader averages. And as always, if you have any questions, feel free to type them on in. And if I'm taking a peek at what's happening in the NASDAQ right now, think about what the weighting is in the NASDAQ. You know, what are the sectors that are going to benefit or going to contribute? I guess another maybe more powerful way at the moment is to think about what's going to contribute to the follow through in the NASDAQ. And when we get the answers to these questions, gang, that's the first step of watch list building. You know, a lot of the growth we've seen in August and September in our accounts based on our sector secrets mastery trades have been based on getting the watch list dialed in to where the follow through is most likely. And when I'm looking at the NASDAQ, we're looking at primarily technology, semiconductors, communication, and I would kind of throw in here telecommunication because it's such a overlap into communication. And then lastly, consumer discretionary. So this is what is, if we think about the NASDAQ as a motor, you know, these are the, if you will, four cylinders of this bigger motor. And the more we see all four of those moving together, the better, right? Sometimes there might be one cylinder or even a couple stocks that look better than the broader average. And I'd have to say XLY is definitely the outperformer in this group of sectors. So that's where we start to whittle down our list. And that's just a bit of the process that we use in the mastery. And we ultimately end up very often looking at names that really aren't discussed in the news. They're not symbols other traders are going to trade unless, well, they're watching this show. They're going to be places where the relative performance indicates continuation is most likely. Why do we care about continuation? Well, do you care about account growth? Then you definitely care about continuation. Finding the symbols that you can buy, and it may not sound sexy, right? I'm thinking about a Coke trade where we bought something for just over $1 and it went to just over $3. Now, if I say, look, I made $270 a contract, for the most part, and this is a sad truth, most folks' eyes just glaze over, right? $270 per contract. But what they're not thinking about is because we're not buying a $4,000, $2,000, $900 option, right? We're buying a $100 option. Now we start to think about the way in which if we are buying 2 contracts, 10 contracts, 15 contracts, right? And then we multiply it out. And the really cool thing about finding these unusual names is that a lot of times, because they're not hot stocks and because they're not hot sectors, they're not also, usually they're very, very, very affordable. And I like to use the word scalable, but a lot of folks don't like it. So let's think about what I mean. If you've heard me use that term in the past, can I buy multiples of that contract? Most folks here with less than a $20,000 account may not be buying 100 contracts. You may not be buying a $3,000 option. These are not unusual scenarios for larger accounts, but what if you're a smaller account? All right, so the cost of the option matters a lot. The other part is it liquid, right? Is there a good amount of open interest where you can move easily in and out of a certain symbol? And is it affordable enough to buy multiples of it? And that's where certain symbols just shine. We did something similar in IBM. IBM was a $4 and $20 option. So $400, $420. This ultimately went to $15.50, right? So the first target wasn't a big one. The second target was pretty good. But by the time we get to second, third, and finally closing, at that point, we took $400 and turned it into just over $1,500, again, per contract. So now you might say, Rag, I could buy 3, 4, 5 $420 options. Others might say, Rod, I could buy 10 or 20. And this is what we mean about being able to build, not just a custom watch list. I mean, who's talking about IBM right now? Nobody, right? A custom watch list and having a custom sort of risk management and position sizing approach for your account. And that's where a lot of traders get hurt. They're looking at a one size fits all approach to growing their account when, I wish it was as easy as putting on a ball cap, but it's just not, right? These are the differences between what we want to do when we're looking at our account, trying to grow it, as opposed to maybe mimicking someone else who's already gone through that process. It's like comparing your chapter 2 to their chapter 27 and wondering why you're not getting the same results. It just doesn't work, right? So if you're on chapter 2, maybe you're on chapter 1 of this book of account growth, right? Don't look to someone who's already 70 chapters ahead unless they can show you what they did in chapter 1. And this is chapter 1 conversation. What are you trading? Does it have follow through? And how are you deciding your position sizing and risk management? By the way, my head's totally here in this topic because tomorrow, I can hardly believe it. It's coming up tomorrow. We're going to be looking at, and here's the link, simplertrading.com/reliable tomorrow at 8 p.m. So this is Tuesday. It's Tuesday, September 24th. Did y'all know that yesterday was the first Matrix 25th anniversary? I couldn't believe it. I was watching the original, which is still as brilliant as ever. Yesterday was and that's probably one of my favorite movies of all time. So 25th, can you imagine 25 years since the first Matrix? And it doesn't feel dated at all. All right. So we're going to be together Tuesday. There we go. September 24th, 8 p.m. simplertrading.com/reliable. All right. So let's see what kind of questions we've got coming up here. A lot of questions, and thank you for the questions, Gabe. There's a lot of questions specific to which sectors will benefit from rate cuts. And if you're logging into this show, you know that sometimes, I'm going to give everyone a spoonful of medicine only because I care and I want everyone to be able to find the clarity they need. Not, so much of trading is this really odd amount of certainty around this is what's going to happen and this is how it works versus it's probable. Nobody likes it's probable. And yet that's truly the world we live in. But the hordes are following somebody who says this is what's going to happen as if they know. So we're never going to know with absolute clarity what is going to be the hot stock, the hot sector. But what we can do is look at the clues as those things are happening to say, oh, this is where the clarity is, right? So nobody can say, well, this sector is going to be the hot one because the Fed cut rates. By the way, darn near everything but defensives are going to be happy about the Fed cutting rates, because think of it this way. For the last 2 months in the Sector Secrets Mastery, a lot of our account growth came based on defensives, right? So I'm going to show you all, and I've been showing you all a lot, because what I'm hoping we're going to do, together is normalize trades. What am I in? What did I trade and enter per contract? And what did I exit per contract? What did I risk per contract? And that kind of conversation. Analysis, look, whenever I'm on YouTube, I'm thinking to myself, nobody here needs another video on just straight up analysis. I want to know what somebody's in and why they're in it. So why do we focus on defensives for so much of August and September? Because they were the outperformers. Even though there was expectation for rate cuts, the defensives, XLU, XLP, XLRE, continued to be where the attention was. Where the attention is where the money goes, where the money flows. That's where we get our continuation. But now that we've cut rates, the one thing I will say that's less likely to occur with the same vigor it did in August and September is all of a sudden, especially as we go into the end of the quarter, are traders and investors and money managers and so forth going to be thinking about continuing to be defensive, or are they going to start saying, look, where can we start buying things with expectation of more return? You don't get into staples because you're looking for a huge return. Your defensives are exactly that, defensive. They're not offense, right? It's a defense. And if we're looking at where the offense is, right, where are we going to air the ball out as opposed to dropping into a zone defense, right? Going into a prevent defense. What are we going to do? We're going to air the ball out. Where are we going to air the ball out? Well, that's what sector rotation is. Sector rotation is money managers and folks looking at where they want to allocate dollars and have the possibility of the most continuation, right? We're all looking for it. Doesn't matter if your account growth is a $10,000 account to 100, or if you're a money manager with 100 million under assets, we're all looking for account growth at the end of the day. So when I look at what is likely going to benefit, I'm going to look at where we could see some sector rotation. That's one thing to look at. I want to look at where there are early signs of a trend coming in. So what was starting to surge going into last Wednesday, and then what is able to hold going into end of month. So we're going to have a really good look in the next 7 days at 2 weeks that will likely start to fortify that watch list. And gang, it doesn't happen overnight, and no one sees the future, right? So in the next 2 weeks, and I think for a lot of you that have been watching my videos, or you're in the Sector Secrets Mastery, you're probably already familiar with where we're starting to align to and what we're starting to ease up on. But I would say keep an eye on what's happening post the rate cuts and into the end of quarter. And at that point, we're going to have a lot of clarity in terms of the month to date and even a 1 month. Look back in normalized performance and say, okay, this is where the surge is happening. Is the regional bank surge for real? Is the consumer discretionary strength going to be able to hold into end of quarter? Is it really still time to look at staples and utilities and real estate? Or is it time to look at things like metals, mining, home builders, etc.? So that clarity is going to come incrementally, but very specifically between Wednesday when we cut rates and into next Monday when we have end of quarter. So it's pretty exciting in terms of what we know we can start to do to set ourselves up for really the rest of the year. So this next week is going to be really important. It really, in many ways, to set up the next rest of the year. Rohan asked, do I trade leaps? I do not, Rohan. There's nothing wrong with them. I just assume buy shares. We're big fans of buying shares, but if you wanted to do leaps, I'll give you an example. Two of our recent longer term positions are long positions in Mondelez, long positions in McDonald's, MCD, long positions in PEP. So these are all buys that we've triggered from much lower. This entry window was May to June into July, and because I want to be able to hold these positions for years, leaps at some point are still a depreciating asset. So if I'm playing a leap, I'm still stuck with a certain time cutoff. And let me show you why I don't want that. So some of our earlier position portfolio entries at this point are, 2 years plus. And so, for example, we bought XLK back in 2022 during a dip with a cost basis of roughly 120 bucks. All right. So if I had a leap, I'd be long gone. That was 2 years ago. Instead, I have 100-point gain per share on that trade or on that entry at $122 and 120. I think those are the two levels we got in at. So that's why I don't want to be in a depreciating asset. However, that being said, I know that some of our traders, when we put out the alerts for the position portfolios, do trade leaps, but it's not something that I tend to do myself, because I like to be able to hang on to it for as long as I can or want to, rather than knowing that this depreciating asset's ultimately going to lend me to either, well, I guess I could always, if it's a leap, depending on the strike, I could just take the shares at that point. That's not a bad thing either. That's not a bad thing either. So there are different ways to do it, but I focus on the shares and not as much the leaps. All right. Next up is, what else do we have here? Seamus says, did you know that your matrix fact made me feel old? Seamus, I'll tell you what, old is better. New. No, old is better. I'll take it. I'll tell you this, Seamus. One thing I love about trading, it's one of the few places, if you were to, who are the rock star, supermodel, people in our industry up until he passed, is Warren Buffett and Charlie Munger. Warren Buffett, Charlie Munger, Carl Icahn, although Icahn's having some issues. But the cool thing about trading is our superstars, our rock stars, our supermodels in this are in their 70s, 80s, and 90s. Yeah, older is better in this game. There's very little that can replicate just going through the experience of decade after decade. And then luckily there's a lot of books, and a couple of the books on my shelf back there are histories of. One of my favorite is, I think it's called The History of the United States in 5 Crashes. That's a really good one. There's so many books you can read about the history of previous things that have happened in the stock market, in the futures market, etc. When Genius Failed is another great one. So there are books you can read to get that knowledge. But yeah, I'll take it. I'll take it. All right. Let's see. Questions. For your long-term portfolio, do I still utilize the same risk management strategy I do for options? Gwen, it's a variation of. So it's a formula. And based on the fact that we teach you all a formula, and we're going to be getting into this a little bit tomorrow when we do the webinar. But think of it this way. It's a formula, but you can plug in your preferences. Meaning, if I have a trader or an investor who has lower risk tolerance, there's a formula to how many shares or how many contracts, what the risk to the account is, etc., that dictates ideally the type of position sizing, etc., that we should use. And so it's not the same, but it's the same idea. It's the same philosophy. It's a similar formula, but I can plug in different risk parameters, and I mean, this is arithmetic that we're talking about, to make it so that I'm comfortable with the shares or the number of contracts that I bought. And the same thing applies to, I'm going to talk about SPX options tomorrow. No one's really heard me talk about this in a webinar. We've touched on this over the last month or two. One of the things that I found a great way for smaller accounts with the right type of approach to grow an account is SPX, which I never would have thought that would be a sentence I'd be uttering. But yeah, that's definitely something where, based on the understanding of risk, you can plug in your preference for Rog. I'm not as okay with that much risk in my account as maybe another member. So there's a lot of flexibility. So when I talk about custom watch list building, when I talk about custom risk management and position sizing, that's exactly what I mean. What's right for you, Gwen? And so every single aspect of my trading, from day trading to the longer term positions, is subject to that same what's right for my account. All right, gang, I've run over a little bit, but thank you as always for being here for Charts and Coffee. I'll see you tomorrow for Charts and Coffee. And again, if you haven't already, simplertrading.com/reliable. I'll definitely see you tomorrow at 8 p.m. Be good to each other, gang.